Welcome to Iron Financial, the channel where we forge stronger portfolios by cutting through the market's weakness. I'm your lead analyst. Today, we are putting an absolute titan of the energy sector on the anvil. Marathon Petroleum, that's ticker MPC. Now, after their latest earnings report, Wall Street is practically screaming from the rooftops, and they're painting this picture of an impenetrable financial fortress, a cash-generating machine that's just firing on all cylinders. And you know what? When you look at those headline numbers, it is really hard to argue with them. But we're here to figure out if this structure is actually forged from solid steel, or if it's just a highly polished facade. All right, let's get into it.
I want you to take a hard look at this number, 50%. That is the absolutely staggering margin by which Marathon Petroleum didn't just beat its Q4 earnings estimates, they completely and utterly obliterated them. Let's put this into perspective for a second. This isn't like a sprinter winning the 100-meter dash by a fraction of a second. No. This is like that sprinter finishing the race before the other runners have even gotten out of the blocks. The consensus on the street, the best guess of all the analysts, was for earnings per share of $2.72. Marathon came in at over $4. You have to understand, in a sector as volatile and as closely watched as energy, a beat of this magnitude, it's a seismic event. It is a statement of raw dominance that forces every single analyst out there to tear up their old models and start from scratch.
Exactly, and that's the key here. This is so much more than just a good quarter. A 50% beat like this, it signals incredible operational leverage. It signals profound financial strength. It tells the entire market that management doesn't just have a hand on the tiller. They have this deep, almost intuitive understanding of the currents that others are just struggling to stay afloat in. So for serious investors, for the people out there who are building real long-term wealth, numbers like these are the concrete pillars you look for. This is the bedrock. This is the solid foundation upon which you can confidently build a position. When you ask what financial strength looks like when you quantify it, this is it. This is the blueprint for a fortress.
Okay, hold on a second, lead analysts. Before we start drawing up the blueprints for this empire, let's just make sure it's not being built on quicksand. I see a massive number like that, and the first question that pops into my head is always the same. Is this sustainable strength we're looking at, or is it just a short-term sugar high that came from a lucky break in the market? Because look, a 50% beat can absolutely be a sign of masterful execution, but it can also be a massive red flag for extreme unpredictability. So I think the real question we need to get to the bottom of today is this impact fortress truly built on solid rock, or are we just standing here admiring a beautiful structure that's about to be washed away by the next market tide?
That is the central conflict. You're right, and that's precisely what we're going to break down right now. We have to figure out if this glittering profit is real, solid gold, or if it's just fool's gold that's going to fade the second we put it under any real scrutiny. So that's what we're going to do. We are going to stress test this entire structure, and we're starting with that explosive Q4 report. We've got to drill down past those flashy headlines, get our hands dirty, and really inspect the raw materials these numbers are made of. Let's see if this company's armor is as tough as it looks on the surface.
All right, let's just put the core number up on the screen. Let's isolate it so we can really appreciate the scale here. $4.07. That was the actual earnings per share for the fourth quarter. Now remember, the Wall Street estimate, the collective wisdom of some of the smartest analysts in the business, was $2.72. The gap between those two numbers isn't a gap, it's a chasm. This is not a rounding error or a slight outperformance. This is a blowout victory that forces a complete reevaluation of this company's earnings power. What it really suggests is that the engine inside this company is running far hotter than anyone on the outside could have possibly predicted. This is the kind of heavy lifting that fundamentally moves share prices.
And listen, it wasn't just the bottom line, not by a long shot. The strength was comprehensive. They beat on revenue by nearly $3 billion more than anyone expected. So this slide, it really lays out the bull case in stark relief. Massive, undeniable beats on both the top and the bottom lines. In the investing world, that is a powerful 1-2 punch that is designed to knock out the bears. But that's exactly where you have to slow down. You have to read the fine print, not just the headlines. I'll grant you, the beats are impressive on their own, absolutely. But you have to look at the other side of the ledger. Total revenue was actually down year over year. So my question is, how are you building a fortress if your total sales are shrinking? And maybe more importantly, let's not forget the context here. This massive beat, it comes directly on the heels of an earnings miss in Q3. So we've gone from a big disappointment to a massive outperformance in a single quarter. That's the kind of whiplash that gives investors a serious headache. To me, that speaks to volatility, not the steady, predictable strength that I would demand for a foundational asset.
That is a fair point about volatility, skeptic, and you're right to question it. I get it. But to understand the sheer power that was behind this Q4 explosion, you can't just look at it in a vacuum.
You have to look at the fuel that was being loaded into the engine in the quarter right before it. What the company was doing operationally back in Q3 is what set the stage for the financial detonation we just saw. The foundation for this fortress, it was being poured, and it was curing long before that headline number ever dropped. So let's go inspect that engine.
This right here, this is the heart of Marathon Petroleum, the refineries. This is the engine room. And in Q3, that engine was absolutely humming. They ran their entire sprawling, complex system at 95% utilization. I want you to let that sink in for a moment. Across 13 different, incredibly complex industrial sites, they were running at near maximum capacity. That is a monumental feat of logistics, of planning, of engineering. They pushed through 2.8 million barrels of crude oil every single day. And this wasn't just business as usual. Several of their key refineries, I'm talking about the ones in Robinson and Detroit, they actually set new all-time monthly throughput records. So this isn't a company that's just getting lucky with market prices. This is a company executing with surgical precision at a massive, massive scale.
And that world-class operational excellence, well, it translates directly into overwhelming financial power. Now, what's really interesting when you look at this slide is just the raw scale of the cash this machine generates. In Q3 alone, a single 90-day period, they generated $3.2 billion in Adjusted EBITDA and a staggering $2.4 billion in pure cash flow from operations. And that cash, that's the fuel for everything we're going to talk about next. We're talking dividends, buybacks, debt reduction, the whole shebang. For every single barrel they processed, they pulled in $6.37 of profit in the refining and marketing segment. This is the bedrock. This right here is the undeniable proof that at its core, this company is an incredibly strong, well-oiled machine.
And hey, don't just take my word for it. This is a direct quote from the CEO, Marianne Mannon, on the Q3 earnings call. "We believe that we should be able to lead in cash generation through the cycle." Now listen, this is not just some fluffy corporate speak. It's a public declaration of confidence. It's a promise to shareholders that is built on the hard operational numbers we just looked at. Management believes their system is so efficient, so optimized, that they can outperform their peers no matter what the market throws at them. High prices, low prices, it doesn't matter. That right there is the very definition of a solid, all-weather foundation.
Okay, I hear the confidence, and I do. I see the big numbers. I get it. But a fortress is only as strong as its weakest point. You know, any good engineer is going to tell you that the more impressive the structure, the more diligently you need to inspect it for those little hairline cracks. You don't just stand back and admire the highlight reel. You have to look at the sophisticated metrics that reveal how efficient it is under pressure. And when I look closely at the very same Q3 operational data, I see some things that give me some serious pause. I think I've found a few cracks in this fortress's armor. Before we go any further, we need to define a really critical and, frankly, often overlooked term: the capture rate. Just forget the headline profit per barrel for a moment. I want you to think of it like this. Imagine you're a baker. The market offers a certain potential profit for a loaf of bread on any given day. That's what's called the crack spread. The capture rate tells you how much of that potential profit the baker actually gets to put in their pocket after they account for the cost of flour, electricity, and any wasted dough. A high capture rate means you're an incredibly efficient baker. A falling one, well, that's a major red flag that something is going wrong in the kitchen. It is the single best measure of a refiner's commercial and operational skill, period.
And this right here is the first crack that I see. Just look at this chart. In the second quarter, Marathon's capture rate was a phenomenal 105%. I mean, they were so good they were actually capturing more than the benchmark profit available. But then in Q3, that number dropped all the way to 96%. Now, the bulls will try to tell you that 96% is still a really strong number, and you know what it is. But in this business, the direction of the trend is everything. And this trend is clearly down. So my question to you, analyst, is a simple one. If this engine is so perfectly tuned, and this management team is so elite, why is their core efficiency metric slipping? Why is it going in the wrong direction?
And here's the best part. We don't even have to guess why. The CEO told us directly on the earnings call. When she was pressed on this drop in the capture rate, she said, and I am quoting here, "The West Coast was the leading driver. It accounted for more than 50% of the capture change. They saw clean product margins on the West Coast collapse by a whopping 40%. This wasn't some minor system-wide issue. This was a major problem concentrated in a specific, really crucial market. To me, that's not a minor stress fracture in the foundation. That's a significant, identifiable point of weakness."
And the problems don't stop there. Let's look at another, much newer part of the business, renewable diesel. This is supposed to be the growth engine for the future, right? This is the new thing. Well, here's what the CFO, John Quaid, had to say.
He admitted that margins were weaker because their input costs, that's things like soybean oil and tallow, were rising faster than the value of the renewable diesel they were actually producing. So let's be perfectly clear. The core refining business showed a crack on the West Coast, and the growth business of renewables is getting squeezed on costs. This doesn't look like an isolated incident to me, it looks like a pattern.
And this just brilliantly illustrates the final point of concern for me. The CFO went on to describe the entire regulatory landscape for their renewables business as having, and this is a direct quote mind you, probably more unknowns than knowns right now. That is a stunning admission of uncertainty from a C-suite executive. So to recap the bear case on their operations, a key efficiency metric is slipping, a major regional market is a significant headwind, the supposed growth business is underperforming, and management themselves admit the future of that segment is a giant question mark. That does not sound like a fortress to me. It sounds like a structure with some serious and, frankly, undeniable foundational risks.
You've pointed out some very real headwinds, skeptic, and I won't deny that. Market conditions, especially on the West Coast, were tough, and yes, the renewables business is still developing. But you're focusing on hairline cracks that are being caused by short-term market turbulence, while you are completely ignoring the massive structural steel support beams that are holding this entire enterprise up. And those beams are the company's unwavering, aggressive commitment to capital returns. That is where you see management's true confidence, not in their words, but in their actions.
Let's move on and see how this builds. I want you to look at what they did in Q3. The very same quarter that you're highlighting for its weaknesses. They returned nearly $1 billion, that's $926 million, in cold, hard cash to their shareholders. They didn't pull back, they leaned in. They spent $650 million buying back their own stock, which is a clear and unambiguous signal that they believe it's deeply undervalued. And then, as if that wasn't enough, they raised the dividend by 10%. Now, a 10% raise isn't a token gesture, it's a long-term commitment. Companies that are dealing with foundational risks, they hoard cash. They don't make moves like this. This is an act of supreme financial confidence. This is management putting their money where their mouth is, consistently, quarter after quarter.
Okay, the capital return is aggressive. I'll admit it. It's a strong signal, I will give you that. But it brings us right back to my very first question. Is it sustainable? Are these massive buybacks and these big dividend hikes being funded by that core refining engine, the very same one that we just established is subject to volatile margins and major headwinds out on the West Coast? Because if it is, then you're just gambling shareholder returns on the hope that the crack spreads stay high. A truly durable structure, a true fortress, needs a more reliable, more predictable source of funding. So I ask again, where does that $1 billion of cash really come from?
That is the crucial point. And the answer is the secret weapon in the Marathon portfolio. It's the element that most casual observers completely miss. It's not just the refining business, it's this, MPLX. This is Marathon's midstream master limited partnership. Okay, so if MPC's refineries are the factory, I want you to think of MPLX as the national highway system it owns to get its products to market. MPLX owns the pipelines, the terminals, the storage facilities. It's basically a toll road business. It gets paid for moving and storing energy, which is a far more stable, predictable, fee-based business than the volatile world of refining. MPLX is the durable, growing cash flow machine that underpins the entire capital return strategy.
And this, right here, is the knockout punch for the bull case. Here is the CEO, again, laying it all out in plain English. She states they now expect to receive $2.8 billion a year in cash distributions from MPLX, and that fire hose of cash is growing. MPLX is targeting a 12.5% distribution growth rate for the next couple of years. So this means the predictable, stable cash flowing from the midstream business to the parent company is set to grow towards $3.5 billion annually. So the crucial point is this. These shareholder returns are not a gamble on refining margins. They are backed, they are secured, and they are funded by a predictable, contractual, and growing stream of cash. These aren't temporary props. These are the structural steel beams holding up the entire fortress, allowing it to withstand any storm in the refining market.
Okay, so we've stress-tested the foundation, and we've located the structural steel supports. And we've also identified and inspected some pretty significant cracks in the armor. Exactly. So let's lay out the final blueprint. We're going to put the bull and the bear cases right next to each other, giving you the complete architectural plans. Look, this is the information you need to make your own informed decision. We're not here to tell you what to do, but we're here to give you the tools to forge your own path.
All right, so the bull case rests on undeniable, quantifiable strength. You've got that massive 50% Q4 earnings beat as the headline. That is supported by proven, world-class operational excellence. I mean, running a system that complex at 95% utilization is just incredible. This execution generates powerful, industry-leading cash flow, which in turn fuels an aggressive shareholder return program of buybacks and dividends. And most importantly, the entire structure is backstopped by the durable, growing cash distributions from MPLX, and that provides a predictable funding source that de-risks the entire investment. But the bear case, it highlights the very real risks that come with operating in this sector. That headline beat came alongside a year-over-year revenue decline, which is a troubling sign. The company's core efficiency metric, the capture rate, it slipped sequentially in Q3, and that was driven by significant headwinds on the West Coast. The much-hyped renewable diesel segment is showing margin weakness and faces massive regulatory uncertainty. And we can't ignore the balance sheet. The company carries a significant debt-to-equity ratio, which adds a layer of financial risk, and it reduces their flexibility if those volatile refining margins turn sharply south.
So there you have it. Marathon Petroleum has clearly forged a powerful machine, one that is meticulously designed to generate and return enormous amounts of cash to its shareholders. The operational performance is strong, and that MPLX structure provides a unique and powerful layer of stability. But the entire energy sector operates inside a furnace of market volatility. The question you have to ask yourself is this: will that intense fire temper the steel beams of this fortress, making it even stronger and more valuable over time? Or will it exploit the cracks that we've identified, revealing a fatal flaw in the design? The blueprint is in your hands. Now it's up to you to decide whether this is a fortress you want in your portfolio. For Iron Financial, I'm the lead analyst. Forge wisely.